soft drinks is a famously good sector to invest in. Obviously, I'm a Buffett fan, so we've got Coca-Cola there. Monster Beverage is one of the best performing US stocks of all time. And then in the UK, I used to own Britvic. I owned Britvic for quite a few years. And Nichols, I think, is a great stock. If you look at its long-term chart, it has done amazing things for investors, but it's not actually done much since 2013. It's been about 10 years. It's done very little. So I'm very interested in that story because I think that if they get their margins back to good levels, it'll be too cheap. It's too cheap at its current level, but there's this problem with inflation.
Hello and welcome to the Fund Your Retirement Podcast, a guest-led podcast aimed at sharing insights and strategies that help you build long-term wealth. Today I'm delighted to introduce Graham Neary. Graham is a full-time investor and an investment analyst for Stockopedia, writing a small cap value report along with Paul Scott. He is also the founder of the Investors Institute, where he helps private investors navigate the markets and upgrade their investing IQ. Graham began his career on the sell side as a fixed income analyst before moving into the buy side as an equity portfolio manager. During this episode, Graham shares his investing philosophy and approach, his biggest holding and why, his biggest lessons from almost 20 years operating in the financial markets, and why he likes fixed income, and of course much, much more. If you like this type of content, don't forget to check out our premium feed with private investors Maynard, Bruce, Roland and Mark, where they discuss their portfolios and the markets in a mix of healthy debates, lively conversations and in-depth discussions. And you can submit your questions for them to answer through your personalised podcast feed. Just visit www.pipod.co.uk. The link to join is in the show notes just below, along with all of Graham's links. With that being said, let's get started. Hello, Graham. Thank you very much for joining us today. Really appreciate you coming on the show.
You're very welcome, and thanks for having me.
You're welcome. As with all the podcasts, Graham, I like them to start off with a bit about their journey, their experience. How did you get started investing? What was a trigger that got you started on your journey then?
Keeping this brief, I developed an interest in economics when I was in university. That led to getting some internships while I was finishing my course. Then I got a job in finance. People might be surprised to know that I was actually a technical analyst looking at charts. Some people might find that shocking considering that I don't do any of that now, but that was my first job, looking at the charts, the wiggly lines and the Ichimoku clouds and all that. I did that for a few years, and then I moved to an insurance company where they had equity portfolios, and I was managing them and also helping to manage the fixed income portfolios. So I was doing a bit of both. And I've always found fixed income very interesting. It's a lot bigger than the equity market, in fact. There's a lot to cover there. But equities was my focus at that company in London, and I was there for 4 or 5 years. Then I took a year out and went traveling and studied Chinese and had a great time. And while I was away, I started my writing career, writing about shares. And as I rotated back to the Western world, at the end of my year out, I started working with Paul Scott at Stockopedia, doing the small cap value report because small caps have a special appeal, which I guess we can talk about later. And so for the last 5 or 6 years, I've been writing about small caps, occasionally large caps as well, managing my own portfolio. I've been teaching people finance. I've been managing 1 or 2 of my own websites. So doing a lot of different little things, doing a lot of my own investing and speaking to a lot of people and just enjoying the fun. There is a lot of fun in the stock market. There's a lot of weird things that happen, a lot of controversy and stimulating interest in other people. It's been a fun journey. That's where I am right now, Lee.
Yeah, brilliant. Excellent. And something you mentioned there when I've been speaking to many different private investors on the podcast, you mentioned their fun and love. You clearly enjoy this. And that's an important part of it, isn't it? You've got to enjoy what you do. And I think for anybody who's thinking of getting started, then clearly having a love for it is important. So fast forward to today, what type of investor would you describe yourself as then? Value, quality, dividends?
Yeah, it's best for most people if they try not to get too stuck on value or quality. What tends to happen is if people focus too much on one of those things, they end up missing something. They either end up buying the worst possible junk shares because they're cheap, and I've done that. And then they also may end up paying too much for the very good companies. So I try to avoid both of those mistakes. So I'm probably got a foot in both camps, value and growth. Obviously, I write the small cap value report with Paul in Stockopedia. Actually, I'm not the only writer there. We've got Roland as well. We've had other people over the years. But clearly, my bias is in the value camp. But quality is extremely important as well, especially if you're risk averse like I am. You don't want to miss out on important risks. And I think a lot of the quality lens is really about finding good companies that will be around for a long time, which helps to reduce the risk. I'd have a foot in both camps. Dividends, I think, are nice, but it really depends on the company itself. Some companies should not be paying dividends, depending on the stage that they're at, whereas some companies definitely should be paying dividends. So it really depends on the stage that the company's at, which determines whether it should be paying dividends.
So dividends more of a bonus to you than are they?
To be honest, I prefer a good share buyback. A good share buyback to me is better than a dividend because it doesn't leave me with a reinvestment problem. I don't have to work out what I'm put to do with the cash. And also, if you really believe in a company, the share buyback is increasing your ownership of the company because the share count is declining and you own more of it. So for me, a good share back is a lot better than a good dividend. But there's absolutely nothing wrong with dividends. And it's certainly a nice little cushion to have a little bit of dividend income. And I suppose someday when we're a bit older and we don't want to do this anymore, we can hopefully use our dividends to pay for things someday. Certainly, dividends have their place.
Agreed. So if someone was to say to you, what were the 2 or 3 main metrics that you look for when you're looking for a company? What would you say?
So the first one might be to ask who owns it and who is running it. So founder companies are very good. Family companies are very good in general. So who's running it? How long has the company been around? The board of directors. One of the worst red flags for me, although I try not to talk about this too much because you don't want to be too negative. But when you see a CEO who did 2 years at this company and got paid loads, and then 2 years at this company and got paid loads, and then he or she is at a new company and it's in a completely new industry that they've never worked in before, so they don't know the customers, they don't know the competitors, and again, they're getting paid a lot, and they'll probably be gone in 2 or 3 years. That's something I try to avoid. I'm looking for CEOs who have been in the industry for a long time. I think that's something that's very valuable. I really want the CEO to understand the customer. A lot of the investments that I have involve companies where I have been a customer or I understand the customer, and that makes it a lot easier to know what's happening. And similarly, if the CEO understands the customer, that's a pretty basic starting point. So that's a non-financial metric to just say who's running it and who owns it. In terms of financial metrics, there's obviously some very good value metrics, but then you just ask, what's the return on capital? That's a basic quality metric. A similar but different one is return on equity. Return on equity is a little bit more dangerous, but return on capital is a great start. And if you find a company which has a very high return on capital, that instantly gets me interested. There's something special happening there. It could be that the company is just lucky this year and it'll go back to an average return on capital in the future. Or it could be that they have a sustainable competitive advantage, which means that they earn returns on capital better than other people can. So that's where I'm looking.
Would you mind sharing a couple of your best performers and what was it that drew you to them? So for anyone listening, probably what you're invested in now has already left the station, so to speak, but just to give the audience an insight in what was it that first alerted you to them that this could actually be a good share to invest in?
Sure. I'm happy to discuss my top holding, which is a small company called Volvery with the ticker VLE. This has actually been a drag on my portfolio for the last few years. I bought in below £5 and it was a bagger for me before too long, but then it's drifted in the last few years. So it's been a frustrating holding for the last few years. But just in terms of what caught my eye, management who were brothers who had big stakes in the company, were very experienced, and price, it was available at a discount to net asset value, which I thought was attractive because it was, and it is, an investment company with a very good long-term track record. I'm obviously not recommending it as a buy today, although personally I'm not selling it. I still have high hopes for it. But in terms of what attracted me to it, it was really management and the track record and valuation. So those three things were all very good. I've had other very strong performers over the years, but I've generally top slice them, which I think is a question you might be thinking about asking later.
You've just answered it.
Yeah, I had a big stake for me in H&T Pawnbrokers, and I don't own that one anymore. But that company has been around for a very long time, and I still write about it today, and maybe I'll own shares in it again someday. That was a huge stock for me personally. It performed very well, and I suppose what attracted me to it there was it's the biggest pawnbroker in the UK by a mile, and even now, it's been a couple of years since I sold out of it, but it's much, much bigger than the second nearest. There's another smaller company called Ramsden's, which is also a listed company. It has the ticker RFX. But H&T, which has the ticker HAT, what drew me to it, it had this long-term heritage. When you find a company that's over 100 years old, that tells you something. Another one of my top holdings is Burberry. I can't remember off the top of my head how old that is, but I'm pretty sure it's over 100 years.
Yeah.
So I like companies that are over 100 years old. If I feel like I'm buying something solid there has to be something special about it if it's been around for 100 years and it hasn't gone bankrupt or collapsed at some point during that time. A lot of what I would call quality investing is actually just reducing the risk by buying things which have been around for 100 years and which you think will still be around in another 100 years.
And buying them at a good valuation as well. Just wondering, how many stocks on average do you hold?
I'm currently at 10.
Right, very concentrated then.
Yes, I generally have 50% in the top 3. And there have been times when I've had a third of my portfolio in one company or even more. Yeah. But I don't think that's a problem if it's because the company has performed well. I often don't know which of my companies is going to do well. And if it does well and it ends up being 40% of my portfolio, that's a high class problem to have. Berkshire Hathaway, which I own shares in, I think half of their equity portfolio is now Apple. It's not half of their entire assets, but it's half of their stock portfolio, which is because it's such a good investment. Yeah. So one of the consequences of investing is that if you don't sell, some of them are going to do really well, a lot better than the other ones, and you end up with a concentrated portfolio. So it just happens.
You mentioned their small caps. You've mentioned Berkshire Hathaway. Do you have a certain universe that you invest in, or is it just you're just looking for a good company, international, domestic, small cap, large cap?
I am now investing in the US and the UK. I was talking to one of my longtime correspondents, customers, friends the other day, and he was saying that he's given up on the UK and he's only buying the US now, which I think is interesting. The US market has outperformed the UK and other markets by so much. I think there's probably a bit of complacency there now. If you're active on Twitter and you're watching US FinTwit, there are so many people now who are all in on the S&P and they're buying these American dividend ETFs. And the yield on these ETFs is really low, but because the market has performed so well, I think they're extrapolating into the future and they're just saying, this is it now, this is all you need. I am a huge believer in the US stock market, but I'm also hopefully a realist in terms of valuations. And the UK market is so cheap now, especially the small caps. I think it's mad to think that these valuations are sustainable in the UK. I think there are so many companies at levels that they would not normally be at. So I'm mostly in the UK. I also have a little bit of US in the sense that I have Berkshire Hathaway, which is one of my top holdings, and I have shares in Alphabet, which is a company I admire for its incredible monopoly power across so many industries. One of the themes that I've actually had in my investing work is monopolies. And I think Alphabet is an example of a monopoly, not just one, but many monopolies. Hopefully I'm not spreading myself too thin, but I've got a monopoly strategy. And then I've also got companies which I just like for a variety of reasons. And maybe they're not outright monopolies, but I still think they're good companies. Maybe because they've got good brands. Yeah, I'm a bit of a mix.
Do you attend AGMs? Are they important to you?
Yeah, I've attended a few AGMs. It's not something I do regularly, but there have been times when I wanted to attend the Volvery AGM because I think at one point it was 40% of my portfolio or something. But if you're not going to attend an AGM in that situation, you're never going to attend an
Yeah.
AGM. I attended a few Volvery AGMs. I think they had them online then. I started watching them online, which was convenient. I also attended the AGM for a company where it was trading at a massive discount to its assets. And myself and a few other shareholders were hoping that they would just liquidate the thing and call it a day, but
Mm.
they didn't. But we attended the AGM to get an insight into would they give up and just cash out the company, but they didn't. It was worth going to the AGM to find out. I actually sold my shares in a diner half an hour after the AGM, the last one.
So that was pretty important going to that AGM then, wasn't it? To come out and make that decision. It clearly had it had a massive impact on your decision of what to do with those shares.
Yeah, it was a very simple decision then once I realized what the management were thinking or not thinking, as the
Yeah.
case may be. I think going to an AGM it's not for everyone. I wouldn't recommend it for everyone. I think for the average person, if they have a diversified portfolio and it's probably not worth their while, but if they're very interested in a particular company or there's particular information that they want to ask questions and it'll be more effective to do that in person, then absolutely. It definitely does give you an insight into management's personalities much more than just reading their statements.
Or if you've got 40% in one company, then it's worth attending as well. You also mentioned earlier on as well, you've bought a junk. So at the other end of the scale, what's always interesting for the audience to hear is companies that you've bought that haven't performed as well as you expected. And how did you handle that? What did you do? When did you realize?
Well, I'm embarrassed to admit that I actually owned some of the China frauds. There were Chinese stocks that came to AIM. I guess it must be around 2015 or so. I can't remember exactly. They effectively just disappeared. They ran away with investors' money. And obviously, it's impossible to do anything in that circumstance. Now, fortunately, I did come to my senses and sold out in time. So I'm one of the lucky ones, but I do feel terrible for the people who got stuck, who got left holding the bag there. Now, to give you an example of the type of thing I was trying to do, because everyone could see that these companies were a bit dodgy, I set up a meeting with a sell side analyst working at one of the brokers. And I met them and we talked about this particular Chinese stock. And it all sounded reasonable, but then the company did disappear effectively not that long afterwards. I suppose maybe I was still a little bit green in some ways at the time that I thought if these companies have brokers and nomads, nominated advisors, there's all these very official people standing around this thing saying it's legitimate, then surely it's okay. But that's not true. It's not necessarily true. Yeah, you develop a skepticism and a cynicism when you realize that you have to actually kick tires yourself. And if it's a UK company listed in the UK, or if it's a US company listed in the US, then probably fine. But then when you see these foreign companies that have domestic stock exchanges they could list in, but they choose not to, then you realize there's something strange happening there. But I've also invested in a UK company that went completely broke. I invested in Albemarle Bond, which was a rival to H&T. It just went broke. That taught me something about leases. That taught me about off-balance sheet liabilities. That company's balance sheet looked strong, but in reality, they weren't strong at all because their leases finished them. So the accounting rules have actually changed since then. So you have to have your leases on the balance sheet, not off them, which I think is good in principle. But in practice, it does make balance sheets very complicated now. I've made some terrible mistakes. That was my one and only zero. Fortunately, in my investing career, I've only had 1 0, and it was Albemarle Bond. But if I hadn't sold the Chinese stocks, they would have been zeros as well. So I had some lucky escapes there.
And in hindsight, is there anything that you've learned from that going forward with those companies, or anything that you've integrated into your sort of investing philosophy to try and help negate those types of investments?
The Chinese stuff was an example of a value philosophy taken to an extreme because they were trading at very low PE multiples and the balance sheets were amazing. But for all we know, the numbers were made up. So the value philosophy doesn't work if the numbers are made up. So that forces you to come up with a different plan. So that's where quality comes in. Quality would say Chinese shoe manufacturer listed in London instantly says not quality. A Chinese shoe manufacturer listed in China, maybe. And then for Albemarle Bond, that just taught me about leases. And it taught me, again, that the value philosophy had problems because they had a rich balance sheet, but they couldn't liquidate it quickly enough. So if you buy a cheap company that needs to liquidate, actually the liquidation process can be slower than anticipated and the company can be insolvent. This company was sitting on gold, literally, but it couldn't sell it quickly enough. That was another important lesson.
And I guess because that one went to zero, you were probably waiting for a turnaround sort of situation on it.
It was quite a few years ago now. I'm trying to remember the details. I think there were rumors that the largest shareholder would invest in them and refinance them. And then after the share price continued collapsing, and then investors were thinking maybe they'll refinance somehow. We'll just get some more equity in, get some more money into the company to keep it going. You reach a point, if the share price is down 90%, you reach a point where it's not really worth selling. If you're only going to get a tiny scrap of money back,
yeah,
you'd rather just get the zero.
Yeah, just be done with it. Take me out my misery.
Yeah, just take the zero and let that be a lesson.
Yeah. You have to pay for your lessons in this business, don't you?
Yeah.
I take it stop losses, they don't rate too highly for you then. It's not something you implement.
No, look, stop losses are not for me, but I think they do make sense for other people. If you are trading, if you have a view on something that's going to happen in the short term, and if your view is proven incorrect by the share price falling, then stop loss makes sense. If you're leveraged, obviously you need a stop loss because otherwise your account is going to be ruined. So some people need a stop loss, but for me, it would be a disaster to sell something because it had gone down in value, just purely for that reason, because it doesn't mean anything to me. If the share price goes down 10%, that can happen just because the market in general is down 10%. So there's no way I would sell something just because it's gone down. Obviously, if something has gone down by 30, 40%, that suggests that there may be something that you're missing. If you or I own a stock and it's down 30%, maybe there's something that I've missed. But you always want to be thinking about your story. If the stock is unchanged, there may be something that you've missed. It doesn't mean that you want to get out necessarily. It really depends on the specifics. So for me, share prices, they're almost meaningless because I know that sentiment is changing all the time for all sorts of strange reasons. In the current market, a lot of funds have been liquidating their positions and they're forced sellers because if their customers are pulling out their money, then the fund has to sell. So there's a lot of forced selling as well in this market. So you definitely do not want to be selling with the forced sellers. That's just a recipe for total disaster. So no, a stop loss is definitely not for me, but they do make sense for quite a lot of people.
Depending on, I guess, it's your investing philosophy, you're clearly long term, aren't you? So you're happy to ride out the peaks and the troughs. Do you average down then? When you see a 10%, 20% drop, is it something that you buy more if you see that?
It's a good question, Lee, but I think you want to be careful with averaging down. It's certainly worth considering, but I think there's a phrase, isn't there, that losers average down losers? Is that it?
Yeah, I think it's something like that. Yeah.
Something like that. Losers average their losers, average down their losers. So obviously, I'm not a technical analyst these days, but if there is a downtrend in your stock, and if you're buying more, there is going to be that temptation to keep buying. And I just think it can be a little bit dangerous if you happen to be wrong. If it turns out to be Albemarle Bond and you keep buying, it's like somebody at the roulette table when they lose and they think, well, okay, double or quits. I'll just keep going. At some point, it'll either work out or it won't. But if it doesn't work out, you could really wreck your portfolio. I think averaging down is a nice idea. It's worth considering, but you also need to treat it with caution because one thing the stock market teaches you is humility, that you can and will be wrong. And you do not want your losers to be a very large part of your portfolio.
Do you use your technical analysis skills? Do you use them for price points or anything like that? Or is it just that's a past life sort of thing?
I would say no, I'm not using it to time entries or exits, but I do find it interesting because I think the concept of support and resistance is valid because I think it's kind of a self-fulfilling thing that people see on a chart. Oh, we've not been at this price since last year. And I think people get married to particular price points. I was reading about the ARK Innovation ETF, which is run by Cathie Wood. Somebody was saying that a lot of the people who are underwater on that fund are waiting to get back to their entry point
so they can get out.
And I think that happens to a lot of people with a lot of stocks.
Yeah.
They're sitting underwater and they don't have confidence in it anymore, but they're thinking, if I can just get back to break even, I'll sell and I'll forget about it. If enough people are thinking that way, and if there are support and resistance points on the chart which have been hit repeatedly, I think those points can be valid. And I think even on a macro level, I think support and resistance is very interesting. I was looking at a chart this afternoon showing the dividend yield on the AIM index, and it's up at 1.9%. And I could see that in COVID, this yield exploded to a huge level because the entire index was so cheap. But then the last time it hit this level was at the Brexit vote in June 2016. I could see this sort of resistance line. And I don't know, is it psychological or whatever, but it seems as if there are sometimes points when, if markets become so cheap, there are points when people will start finding money under the rug to buy shares. So maybe we're at that point now with the small cap market in the UK that things can't get any cheaper, but obviously don't pretend to know if that's true or not. But I feel like I'm seeing bargains most days now when I look around.
Have you got a couple of names that might be worth looking at?
I suppose this is the point where I invite readers to read, Stockopedia, the small cap value report.
Perfect. I'll put the link below as well. So I'll add the link in so they can read your in-depth writing as well as Paul Scott. So probably be easier to send them there if you want.
Yeah, and I also have a Patreon page where I send out a weekly article which just has one stock.
Mm.
And with that, I allow myself quite a lot of discretion. So it could be a big cap, it could be an American stock. So there, I'm looking for something that's really excited me that week from the entire investment universe. I even did a bond there one time, which I thought was just great value.
Yeah.
So yeah, like every day I am putting out ratings. I shouldn't call them ratings, but we have basically a system where we say green, amber, or red. This is on Stockopedia. We say green, amber, or red. And it's basically saying, do we think it's really interesting, worth further research? It's obviously not a tipping system, but it's saying we think this is really worth study. And then amber, where we're like, it's not okay, there's a few issues. And then red is where we've got a problem.
Yeah.
We really think there's a problem, but we could be wrong. It could still do incredibly well. But, the red ones can be quite fun to write about. It's always tricky in my business writing about stocks because you don't want to be the angry person, the person who's always complaining and saying, look at this terrible management team, look at this terrible company. You want to write about good companies as well, because that's what people might actually use as a starting point to go and do their own research into a good company. It is fun to write about the bad companies as well, I have to say, because sometimes it's hilarious the stuff that companies get up to in this micro cap market. There are some real jokers in that field.
Yeah, Chris Boxall he also does the Fundamental Asset podcast. He often says he enjoys unearthing those not so good companies and writing about them and shouting about them. And that's important, isn't it? Because as you've said, there are companies that go to zero. What's been your biggest investing mistake and what did you learn from it? But would I be right in saying it was perhaps maybe the Chinese companies or the pawnbroker?
I make mistakes all the time. So, I'm constantly trying to learn, not just in my own portfolio, but in my writing as well. If I write down in black and white, the stock looks really interesting to me, I'm really pumped about it, I think it's exciting, and then it does poorly, then that forces me to recalibrate. In terms of recent mistakes, I would say something that I was looking at this morning was Nichols, who make Vimto, which is a soft drink. They are struggling to get their profits back to where they should be. And, I think I've made some pretty good calls over the last 6 to 12 months, but there have been a few where post-COVID recovery hasn't really happened as I hoped it would. And Nichols, it hasn't really happened yet. I still really like the company. Soft drinks is a famously good sector to invest in. Obviously, I'm a Buffett fan, so we've got Coca-Cola there. Monster Beverage is one of the best performing US stocks of all time. And then in the UK, I used to own Britvic. I owned Britvic for quite a few years. And Nichols, I think, is a great stock that, if you look at its long-term chart, it has done amazing things for investors, but it's not actually done much since 2013. It's been about 10 years. It's done very little. So I'm very interested in that story because I think that if they get their margins back to good levels, it'll be too cheap. It's too cheap at its current level, but there's this problem with inflation. It's just ruining so many parts of the economy, to be honest. It's ruining demand with the cost of living crisis for the companies themselves. I think that Nichols said today that their cost of goods, their input cost was up 16%. Which is obviously a lot higher than consumer price inflation. But when you've got a company dealing with that sort of dynamic, It's very difficult for them to maintain, let alone improve their profit margins. I'm not sure if we're going to get a normalization this year. I suppose after this morning's updates, I'm a little bit downbeat on that point. I was also studying Mortgage Advice Bureau. I'm not sure if you're familiar with them, but they've got advisor firms all over the UK. And I think that's a very nice company in a lot of ways. They have a franchise model, so they're capital light, so they earn good returns on capital, which is a key metric for me. But the mortgage market, they said this morning that they've given up hope for H2 to have an improvement because new mortgages, I suppose first-time buyers are having a really tough time with interest rates, with the cost of living crisis just hurting people's budgets. They're not expecting that to improve now in H2. So maybe I was a little bit too optimistic that we would see that improvement by the end of this year. I'm not the only one who was wrong about that, but maybe we're going to have to wait a bit longer for recovery.
Yeah, it's a difficult one to call, that, isn't it? Because obviously inflation and mortgage interest rates, when will the Bank of England lower them again? 0% interest rates was a very unusual time, and maybe many years before we see that again. And perhaps maybe that's right. Maybe we should never see a 0% interest rates again. It did distort a lot of things, and maybe this is the new normal. Maybe 4 or 5% is the new normal, as it perhaps maybe always should have been.
To be honestly, I couldn't agree with you more that I think 4 to 5% is like a healthy rate as an average rate, but inflation at 10% or 8% is not normal.
Not normal. Agreed. Yeah, agreed.
So if we can,
I was talking about interest rates there, not inflation.
Oh, I know, absolutely. No, I know. If we could have my cake and eat it, I'd have interest rates at 5%, and I'd have inflation by
2%,
somewhere small.
1.5 or something.
Yeah, something small. Yeah.
Agreed. You mentioned fixed income earlier on in the conversation. You find that quite interesting. Would you mind sharing a little bit with the audience of why you find fixed income interesting?
Sure. Well, if you're risk averse, fixed income market is basically designed for you because you have a contractual right to get paid, and you don't have that with equities. If you make a fixed income investment, the company or the government is effectively, they're legally obliged to give you your money back.
Yeah.
So it's a good starting point if you're risk averse. But then if you are willing to take some risk, the corporate bond market offers some very high interest rates from time to time. There was an ETF I was looking at before. I can't remember the ticker, but it was a junk bond ETF. People hear junk bonds and they think,
yeah, they run a mile.
It sounds nasty. But a junk bond just means that it doesn't have a triple B credit rating or higher. And one of the kind of structural errors, I think, in finance is that people are scared away from investing in junk bonds, but the very same people will invest in equity that is far riskier than a junk bond. So if you can earn double digit on a bond, I think that's an interesting proposition as an alternative to equities. But it is difficult. It is difficult for private investors to invest in individual bonds. There is a market called the Orb in the UK, which is there. It's a facility and you can invest in small denominations, but it's not very big. It's not very liquid. I think there's a bit of a spread problem. Bid-ask spread is a bit wide. I think for most private investors, if they do find bonds interesting, the way to go might be with a bond ETF. And if you buy a junk bond ETF, you're getting diversification and you're getting a high yield across those holdings. And I think the return is, feel free to correct me if there's a comments facility, I'm sure people will correct me, but I think a junk bond ETF can do nearly as well as an equity ETF. So I think it's an interesting alternative.
That's really interesting. Thanks for sharing. For the person that's listening now, then, they've just picked up this podcast, they're thinking of getting started. What would you say to them? Or would you say to them, don't get started?
Yeah.
Buy an S&P tracker.
Yeah. There's a quote that says, how do you win at poker, or how do you win at chess? And the answer is by not playing.
Yeah.
And I think you can say the same about investing. That for some people, they're better off not trying to invest in individual stocks. But I think for people listening to this podcast, they probably are interested. And if you've got that niggle, that start slowly, ease yourself into it, invest small amounts that you can afford to lose. There's no need to bet the house on a stock. And certainly not when you're starting out. You want to just learn, connect with other people. Twitter is a great place to interact with people, or X, whatever it's going to be called from now on.
Yeah, X, I think that's right now. Yeah.
There's great communities online. So talk to people and make some small investments. And maybe after 6 months or a year, you'll decide it's not for you, or maybe you'll have the bug and you'll want to keep going. And remember that it doesn't have to be all or nothing. A lot of people have a stock portfolio, but they also have some properties. There's no rule that says you can't have buy to let, you can't have ETFs, you can't have individual shares, you can't have a little bit of everything. You can mix and match. I would say slow and steady is the way to go.
Graham, thank you. That was brilliant. Where can the audience connect? Where can they follow you? Where can they learn more from you?
Thanks, Lee. If people would like to stay in touch, the easiest place is my Twitter. My Twitter handle is Graham Neary. That's my name. And from there, they can get links to my mailing list, etc. But twitter.com Graham Neary is the place to go.
I will also put the link to your mailing list as well. So if they want to subscribe, the link will be there. Thank you very much, Graham.
Thanks, Lee.
Well, that's it for another episode. If you enjoyed this episode, please subscribe and don't forget to check out our premium feed, where private investors Maynard, Bruce, Roland and Mark discuss their portfolios and the markets in a mix of healthy debates, lively conversations and in-depth discussions. You can submit your questions for them to answer through your personalised podcast feed. Just visit www.pipod.co.uk. The link to join is in the show notes up below, along with all of Graham's links. Thank you very much, and I hope you have a great day.